Good afternoon or good morning, everybody, and welcome to another Fintech Nexus webinar. My name is Peter Renton. I'm chairman and co-founder of Fintech Nexus, and delighted to be hosting this webinar today as we have an all-star panel and such a fascinating topic. Embedded lending is, I think, one of the major trends in all of fintech that's come really to the fore in the last couple of years, and we're going to dive deeply into that today. We're going to talk about practical use cases, what the actual real ROI of embedded lending is, how to really maximize that, and we're going to really just delve deeply into the different types of embedded lending that is around today. So with that, I am going to introduce I'll let our panelists introduce themselves, and we are going to start off with Yakov.
Hi, Peter. Hi to everyone on this webinar. Great to meet you here. My name is Yakov Martin, and I am Jiffidy's CEO.
Okay, Christine.
Morning, good afternoon to everyone. I am Christine Roberts, and I'm the president of Citizens Pay, which is the point of sale financing division of Citizens Bank.
And Rob.
Yeah, good morning, good afternoon, everyone. Rob Hudson. I'm the head of international banking and payments for FIS. So anything financial services related outside of North America.
Okay, and I think you win the award for the nicest background today.
If only it was real.
If only. Okay, so let's get right into it. Yakov, I want to start with you and want to talk about the use cases for embedded lending today. What are the major financial products? What are the major use cases that are in place today?
So I think the answer to that actually has much to do with the term embedded lending. When we think about the embeddedness of lending, we're actually speaking about products that are tailored, developed, and then implemented where and when it matters most to the end customer. So in other words, what we're doing by embedding these type of financial programs and financial capabilities is really bringing it to the forefront and incorporating it or integrating it into a seamless transaction, or the primary transaction that is taking place. The lending aspect should flow as part of that transaction without any interruptions, or without taking the customer out of context and actually requiring him or her to go and visit some sort of other station or some sort of other institution. And the reason I say that is because based on that context, these products, when they are presented properly, are programmed, are designed to cater to that very instance. So therefore, these products can include different types of loan programs depending on the transaction at hand, but they can also show themselves. They can also be accessible when and where it matters most. So that can be an in-store transaction, that can be online, it can be at home, it can be on the phone. Wherever the transaction is taking place, that is where we want to present the offer and the assistance in a seamless manner.
Okay, interesting. So we want to talk about the current environment that we're in. It's, this is a very different environment to what it was like a couple of years ago. Interest rates around the world are much higher than they were. This is impacting lenders' bottom line as well. So how maybe Christina, could start with you working at a large bank. I mean, how has this the high interest rate economy that we are in today, how is it impacting banks and lenders in terms of their offerings and profitability?
Great question. It really, I think the impact is greater on the consumer. You have an entire generation of consumers who existed in 0% financing. Mm-hmm. And the reality of that is, that will be, stepping down more and more, or stepping up, right, if you will. Interest rates, where they're at right now, 0% financing becomes almost untenable for providers. And so the consumer is now starting to have to get used to, higher interest rates across the board, right? Mortgage rates in the United States are at an all-time high, not seen since probably, going all the way back to late 70s, early 80s, right? And so, what we're really finding now is consumers are getting pickier, right, about how they are financing purchases. Credit card interest rates are in, some credit cards are in, the high 20s into the low 30s in some places. And so what consumers are looking for are alternative ways to continue to consume goods, right, as they need to, but finding different vehicles where that interest rate is lower and the payment is fixed, right? So when you're a rising rate environment, the fear for some of these variable rate interest rate vehicles is that your payment continues to go up. And so they are looking for alternatives. And this is where, embedded financing really becomes practical for consumers and for merchants alike, so that you have a lower interest rate, sometimes zero still, but again, I see the trend of that going away. But it'll be lower, it'll be a fixed payment, and it'll be a fixed term in most cases. And so consumers are starting to gravitate more towards that. And, quite frankly, not all financial institutions, at least in the United States, have those options, right? Citizens does. And so it helps us as a business as a whole.
Rob, what has been from your perspective, how is the sort of the economy impacting lenders?
I think part of the answer lies in geography. So some markets are different. Perhaps the more established Western markets, as Christine says, clearly we're not in a 0% financing model anymore. But I also think that one of the key benefits really is if the lender is a multi-instrument lender. So if you've got embedded lending, singular, somewhat niche players versus those like Citizens and other large banks that can blend rates across various different products. So I think giving the consumer a choice so they can make a judgment call on which instrument they use, and then aligning pricing in terms of rates to that, makes it far more compelling, because you can then choose on the spot whether it's transaction-based after the fact or a portfolio of different transactions. You can choose where to put that, and which product, which interest rate you're going to buy. Just one other quick point. There are some markets, of course, that have lived with installments for decades, where there is an expectation of a certain product rate, certain time, and those are less impacted by the swings in interest rates.
Right. Interesting. Okay, so turning to BNPL, we've seen that, like, just in the last week, we've had the shopping season has begun, and we've seen in the news that consumers are choosing BNPL at a higher rate than many expected. And you got some of the BNPL providers are approaching profitability or are profitable. Yakov, love to get your commentary on what this means for the industry.
So I actually think that this question to some degree relates to the previous one as well in terms of the environment and interest rates. I think what we've seen over the last few years, and I think we've had the opportunity to speak about this quite a bit, was this almost uncontrolled proliferation of various types of entities offering various types of buy now, pay later products. Now, in an environment of 0%, where your cost of capital is also extremely low, it's frankly quite easy to do this. You can offer 0%, you can charge low MDRs and so on and so forth, and you can really reach market share. The problem is, of course, number one, sustainability. Is that sustainable? And as we saw, the moment the market turned, there was a huge fallout. And the other aspect, which again, I think ties into the previous question, is does that encourage responsible spending? When money is thrown around, profitability at the time was not necessarily the number one KPI that the market was looking at when they were evaluating these companies. And I think to some degree that created a bit of a mess. And what we're seeing now, especially with these announcements of approaching profitability or reaching profitability is actually a natural and I think quite a blessed evolution within the market. There was a need to, I don't know if it was consolidation or survival of the fittest, but for certain players to go away if they were not built or structured in a sustainable manner. And I think it forced some of the other players, let's call it the fintech lenders, to really figure out what they should be doing and what they shouldn't be doing. Practices were changed, pulling away from certain products that were unsustainable and irresponsible in my view, to some degree. And what it really also did was, I think it showed the strength of the more traditional financial institutions, who, as we know, are under regulatory scrutiny for decades and have to operate entirely within that type of environment. That in turn results in a more responsible approach to lending in general. And I think it even to some degree guides these financial institutions in choosing the type of industries and the type of brands and even customer base that they want to work with. It needs to make sense to all parties. And again, profitability, I think, is one of the KPIs that indicates a healthier environment and one where our partners and traditional financial institutions really are able to star.
Jakob, I also think it's important for us to differentiate between buy now, pay later and installment lending, right? Buy now, pay later is the pay in 4 over 6 weeks. It is basically a cash stretch versus true installment lending. And I think today, so much of it gets talked about together. And I think it's important for us to differentiate the two, right? Your fintechs play predominantly in, the buy now, pay later sphere versus more in the installment lending front. And it is an important differentiation. The installment lending is truly governed versus buy now, pay later is kind of, you almost going back to the, payday lending kind of, cash, although those are high interest rates, these are 0%. But you think about it, it's much more of a laddering aspect versus a true lending aspect.
I couldn't agree more. One of the things that we didn't do in this forum, and maybe we could or should in our next, is actually go through the terminologies. The terminologies are thrown all over the place and mixed up, and they mean different things to different people. So I think that clarification is extremely important.
Okay, so I want to move on to talking about best practices. We have a global panel here today, so we have different, and I know Yakov, you work in a lot of different countries as well at Jiffity. So maybe Rob, we can start with you. What are some of the embedded lending best practices, and maybe you can represent the UK and Europe?
Yeah, I think part of the answer lies in the degree to which it's regulated, and therefore the creativity or flexibility that lenders have. But actually, it's probably, I'll go back to a point Christine just made there about the terminology. True embedded lending is effectively where we were many years ago, but wasn't embedded. It was onerous, time-consuming, admin-heavy. You still ended up effectively with the same result, but a far more onerous process to get there. So it's taking the point at which you provide the consumer enough time to pause and reflect and think, am I doing the right thing? So you're not making it so quick and easy that you bypass that stage, but you're doing it in a way that effectively, as the name suggests, embeds it into the transaction. You're not stepping to one side, having to use some bureau process, some form of decisioning. So I think that's, and probably those that are the early lenders have done a very good job of recognizing that there are differences in point of sale face-to-face versus online, and have good solutions for both. And I think probably the other areas to look at are those that have been doing this, as I say, for a long, long time. There are parts of Eastern Europe, parts of Latin America, where it has been allowed to mature and it is simply another way to transact. No one actually even stops to think. It's just a very clean, quick process. So I think I would say the early adopters, and then those larger banks that have taken that on board and adjusted. And there are some of the big banks that are effectively baking it into their consumer proposition. I think that's where I've seen most of the innovation.
Mm-hmm. Mm-hmm. Christine, what about in the US? You're on mute, Christine.
Sorry. Similar to Rob, I think that, technology has helped financing become, I hate to sound simple, but truly embedded, right? So now we can embed into point of sale systems, we can embed into online shopping. And I think it changes the dynamic both for the consumer on how they shop, but almost more importantly for the merchant to be able to capture a consumer within their purchase cycle, which is very different. If you go even 10 years ago, right, your options were pretty much, cash, check, or charge card. And so now, Citizens offers a line of credit, not even just an installment loan. So if you go to Best Buy here in the US and you want to buy a MacBook, we would offer you a line of credit that you can continue to use and upgrade your Apple products at Best Buy. And so now financing has become a way to attach to a consumer and keep them in the sales cycle for longer and to get them to upgrade sooner. So now it becomes a marketing vehicle, a purchase vehicle, and a financing vehicle, which was very different from how financing had been used in the past.
Interesting. Yakov, I mean, you work around the world. What are some of the best practices you're seeing?
So it was an interesting comment, Rob, that you made with regard to a couple, probably less than a handful of countries who have had some sort of installment offering baked into their system, sometimes their national switchboards, almost, I would say. I think they were predominantly card-based. Those were obviously living off, so to speak, a line of credit that they had on their existing credit card. And I think what's happened now in the US, and definitely in the work that we've been doing, Christine has described it perfectly, where we really need to sometimes rethink what is the best or the match between the transaction at hand and the type of financing product that is being offered. If it is indeed a line of credit, then that needs to be embedded, that needs to be offered wherever that transaction may be taking place. Now, I would almost say it's a bit simpler when you're doing it online. There's one gateway, there's one checkout page, that's what you're doing, and that's it. But when you start contemplating an in-store transaction, or you start contemplating different types of in-store transactions, some of them you're standing in line waiting or in the queue. This is an international webinar, so we're going to try to cater to all. Waiting to check out or to transact. That's one way of doing business, but there are plenty of others, especially in bigger ticket items, where it's actually more of a concierge type of service, and you expect that entire transaction to take place while you're sitting at a table with a sales agent, or maybe even in the comfort of your own home. So I think that the fact that in certain areas we together had to reinvent the wheel, it gave us an opportunity to kind of re-examine and explore. So as Rob said, certain countries in Europe and some in Latin America had this for decades through their card, built in a certain fashion, and that's great. But we actually in the US had now recently the opportunity to, I think, re-engineer certain things and make sure that the fit was perfect.
Mm-hmm. Interesting. So I want to actually sort of expand on that a little bit, Yakov, and ask, I mean, what is the significance of having different lenders catering to different customer needs and use cases?
Yeah. So again, this is something that we're finding to be shaping itself properly as the market evolves and as the industry matures. We have to remember that specialty or specializing in lending can't be specializing in lending all over the place to anybody of any credit band whatsoever. And I think the expertise that we're starting to find And the pricing, especially in an environment of higher interest rates where you're able to sharpen the pencil, you're able to offer competitive pricing, often that is true for a certain type of credit band. Now, that's not to say that anybody who falls outside of that credit band is not creditworthy. They most definitely can be creditworthy depending on their specific circumstance, but the product has to be a different product. And therefore, once again, by tailoring and matching the audience, the transaction at hand to the credit program and the credit provider, I think we do a real service for consumers, for small businesses, and that's the importance of having them on deck.
I think it's also, though, Yakov, making sure that we are ensuring the consumer and the small business's ability to pay, right? So there's again, when you look at buy now, pay later, it really doesn't take as much of that into focus. And we're finding, again, in the US, there are consumers who are stacking as many as over 40 BNPL payment structures, right? And so you have to wonder, right? How does that affect the consumer's ability to pay for anything? And then that does not get translated within the true lending market as well, because the traditional buy now, pay laters don't report to any of the credit agencies. And so there's this whole dynamic right now that we are working through, which is how do we continue to protect consumers and, quite frankly, small businesses as well, so that they are really focused on their ability to repay. And that also then goes into what Yakov was just saying, right? The products that then are available based on the credit spectrum starts to shift, right? Because we are seeing a return to pre-pandemic credit performance. And, it's definitely starting to affect who you're lending to, how much you're able to lend to them. And then how do we build in sort of the consideration for buy now, pay later? Small businesses, I think, are now the new frontier from a product perspective, right? For the longest time, small businesses have been left a little bit in the dark ages, right? Everything was paper-based. At least, again, I'm speaking more US. I know the European markets have been a little bit ahead of us on some of this, right? But I think the new frontier here in the US is going to be very much about embedded finance for small businesses and automated finance, which normally, financing has taken a day to 2 days, sometimes a week, right, to get even a $10,000 small business credit line. Now we're able to start doing that in 30 seconds. And, again, there's 33 million small businesses in the United States who have been, severely underserved from a instantaneous aspect of credit. And I really see that the next level of embedded finance is going to go towards investing in, how do we get small businesses attached to credit, again, in order to connect them to merchants better and faster.
Just Peter, just a quick point on that, just pick up on a couple of those. First of all, the point that Yakov made there about the different lenders. I think the issue of not reporting to credit agencies is an issue, and it means it's harder for decisioning. So the faster we can resolve that one, the better. But also, a lender who has multiple product offers is far better placed, I think, to provide a tailored, different risk-based. One can decline something but provide something else that's more suitable. And I think that's really a good lender would seek to decline as a last resort and have multiple product types to provide to the consumer.
Peter, I think you're on mute.
You think I'd have this down by now. We're getting some questions coming in. If you do have a question for the panel, we are going to get to those later in the hour. Hit the Q&A button and we will attempt to get to those. So I want to actually, we've sort of been talking a little bit about this, but I want to address the topic of this webinar directly right now. And when we're talking about the real ROI of embedded lending, what does that mean, and how can lenders maximize this ROI? Christine, why don't I start with you?
Yeah, I think it's fantastic. So I think it's it's as much the merchant as it is the lender. And it actually answers one of the questions I think that's in the Q&A. What embedded financing allows is for folks who are, it improves purchase consideration, right? So if you're going out and looking for, say, a new couch, right? And you see a couch that you really, really, really want, but it's $500 over what you have from a cash perspective. Having embedded lending, which also embedded lending typically shows you what your monthly payment will be, allows for the consideration of something that someone wants, right? Allows it to fit within their budget and allows them to purchase possibly a higher priced item that still would fit within their budget over a longer period of time. And so what we see is that consumers purchase more, and they purchase more often from a merchant who has provided them that vehicle to get what they really wanted versus settling for something that they could afford in the moment, right? And I think affordability is still extremely important, right? Don't take an installment loan on something you truly can't afford over that period of time. It's got to fit within your budget. But it allows the merchant to then upsell a consumer. And quite frankly, when you make a consumer happy, they're going to want to come back and shop with you. And so what we have found is that consumers are 30% more likely to spend more with an installment program, and they are 40% more likely to return. And so those economics are beneficial for both the lender as well as the merchant. And quite frankly, it's even more important for the merchant, right? So again, with us with a line of credit, you don't have to go through the process over and over again, right? So a lot of the installment lending today, every time you come, you have to reapply. So with us with a line of credit, you apply once, you're given a set amount that you can spend, you're open to buy, decreases with your purchase, but then increases with your payment. And so that allows the merchant to continue to activate you with different types of products and services. And the merchants are finding that, a very successful path to a connected consumer.
Right. That makes sense. It's like embedded lending as a loyalty tool.
Very
Rob,
much so.
Yep. Rob, what are your thoughts?
Yeah, similar. I think one of the keys is the relationship between the lender and the merchant. The merchant may or would unlikely have insight to the borrowing capacity of a consumer, but once they've established the relationship, they can seek to lengthen the term, if you like, whether that's by sort of fairly small upgrades or whether that's some large replacement product. But they've established that relationship, so they entice the consumer, which for the merchant is great. That's a transaction they may not have otherwise been given. For the lender, similar, I guess, in terms of a line of credit. I mean, it's establishing a point where I am prepared to support my customer to this value, and I will allow them, I might not give them a line of credit per se, but I will allow them to keep buying and add to the ceiling that I've put in place. And I will check along the way and make sure see whether I can put it up, down, much like running a portfolio management credit card type setup. But it's having that relationship, understanding payment behavior, repayment behavior, and then the merchant doing that, if loyalty is the word we want to use here, but it's having that constant interaction with the consumer that allows them to bring that consumer back when otherwise they may have gone elsewhere. So true ROI, relationship, communication, having access, establishing the relationship is gold dust particularly for the merchants.
I may just want to add on top of or connecting what both of you said. I mean, absolutely, there is this longevity of the relationship that is established through these types of vehicles, right? Even starting with giving the consumer or the small business the ability to make the right purchase. Christine, you mentioned before, something that otherwise they would have settled for, something that was subpar to them simply because of affordability, and allowing them to really choose quality, for example, or choose the right fit for their need is an incredibly important and I think impactful aspect of providing these type of financing programs at that very point. And the fact that based on affordability or ability to pay, those payments are being made over the course of a certain amount of time, that in and of itself lengthens and deepens that relationship. But one thing that we have to remember is that from the consumer's perspective or the small business, that relationship is really joint. That means that when a bank locks arms with a merchant, that partnership, the choice, that pairing of the bank and the merchant together is so important, because from the consumer's perspective and from the small business's perspective, they're transacting with both essentially. They associate them with each other. And therefore you choose your partners carefully. And it's super important for merchants to realize that the identity, the prestige, and even I would say the brand of their banking partner is important because it's going to reflect on that consumer's ongoing relationship with the brand.
That's a really interesting point, Yakov. Yes, indeed. So, Christine, I want to turn back to you and talk about, citizens. I mean, if this is a complicated industry, there's no one size fits all. You've talked about your line of credit product, but when it comes to embedded lending, what is the business model that's worked for you?
For us, it's really been about partnership and finding merchant partners and technology partners like Jiffity that make the most sense to bring together. I don't know that our type of financing, I know that our type of financing is not right for every merchant in the country, right? Very specifically, we feel that it's our responsibility to ensure that consumers are using embedded finance in a way that is smart borrowing versus trying to borrow for everyday expenses, right? So you won't find us in grocery stores, right? You won't find us in where maybe a buy now, pay later is better suited from a cash extension perspective. We really look at, average order values over $1,000, right? We want to help consumers consume smartly. And so, it's important for us to make sure that we have the right level of partnership between the merchant and, our technology partners. We customize the build, because every merchant is different. I don't think, out of the box solutions, again, are great for a smaller merchant versus when you're dealing with the likes of Best Buy or Apple or Microsoft, who are clients of ours. We want to make sure that we have a solution that very much is specific to the needs of them and their consumers. And so that partnership is just, it's key. It truly is key. And again, we don't look for, there's plenty of products that are effective for smaller merchants, for smaller ticket value components, but we tend to really focus on the partnership for a higher order. Okay,
so Rob, I want to turn to you because you've touched on this, but I want to dive into it a little bit more deeply, because there's a whole range of stakeholders here. We've got the lenders or the bank, we've got acquirers, we've got the payments processors, we've got the merchants, we've got the consumer. So how do we blend the needs of all these parties for an optimal result?
Yeah, possibly even more with ISOs and brokers and third parties.
Right.
Difficult to imagine how you can dissect the transaction and make sure everyone gets a piece. But I think effectively there are some givens, right? So the consumer, one would have to assume, is comfortable and happy. They have choice. They can spread payments to make it more affordable. So they have convenience, choice, and so on. The merchant, as we've discussed, potentially has a repeat customer. They certainly have a transaction they may not otherwise have got. So there are some sort of non-financial benefits. And then I think you've got traditional financial instruments. So however we want to phrase it, it's effectively a loan. You have a lender that can make, clearly can benefit from the financials associated with lending that money. You have an acquirer that gets fees from transactions. You have an issuer that, again, potentially has its own financial model. So you could argue that it's actually financial construct that's been around forever. And it's just a different way to do a transaction, but protects all of those actors in standard traditional rails. But also you've got, and points made, I think, partly by Christine, you've got the upsell. So where you might have, I will go buy something from the grocery store, versus I'm going to buy something of significant value at perhaps twice the price I would have previously been able to do that because of embedded lending, then everyone who benefits anyway because of established models now benefits potentially even more so because they have higher value. And I think that's, I don't think we're revolutionizing transaction rails here. I mean, it's, as the name suggests, it's embedded, it's a transaction, everyone's used to it, everyone's been used to it for a long, long time. This is about adding and giving a little bit more, both choice and value. Yeah.
Okay, so we're going to switch to audience questions. We've got a lot of questions coming in here, so I want to spend a bit of time on them here. So first one, much of the focus has been on consumer lending. Would the panelists comment on trends in B2B credit via finance embedded in marketplaces, supply chains, and other platforms? Who wants to take that?
Christine?
Well, I think I was talking about it before, right? That,
yeah, you touched on it. Yeah.
Business, I think, is becoming, the newer frontier. We're seeing a lot of retail merchants, quite frankly, asking for, embedded finance capabilities for small to medium-sized businesses. Jiffy and I have been out talking to several businesses, here, merchants in the United States, regarding, bringing that to the forefront. And I think, the merchants that adopted embedded finance for consumers earlier are now looking at the benefits of that and how that now translates to small businesses. So both from a retail perspective and online perspective, and really are interested in being able to, more quickly approve a small business for financing, and honestly being able to replace some of the more standard, payment terms that they have today, right? So allowing small businesses the same access to embedded finance and installment lending versus the, paying 30, 60, 90, right? And allowing businesses to grow in that way. I mean, Jiffy's platform is beautiful, so why wouldn't they?
Thank you. Peter, you probably sense the excitement, both in Christine's voice, I think in my own as well, about this whole category.
Yep.
If we think about it, there are a few different aspects to consider. Number one is when you speak about small businesses, you have to remember that every small business owner at the end of the day is a consumer, him or herself. So if they've become accustomed to some degree to having these things at their fingertips as a consumer, they learn to expect this for their business as well. But from another perspective, I think one of the things that really gets us excited is, as Christine mentioned before, I think both our organizations are very much focused on the types of transactions that are meaningful, that are impactful, that can really be sometimes even life-changing, right? Making sure that you really make the right choice for the right reasons. It's affordable, but you are able to take advantage of these type of loan programs. When you think about small businesses, that can be the make it or break it for these small businesses. If they're able to get the type of funding for the type of equipment that they need to really grow and thrive and hire additional staff and so on and so forth, that can be ultimately life-changing, not only for the small business, but for everybody they employ and ultimately for their communities at large. The last perspective this probably warrants a separate question, or maybe even separate webinar, but is to think about the interesting junctures where small businesses or even medium-sized businesses meet this need. For a consumer, it usually boils down to in-store, online, maybe at home. But when you think about supply chains or other types of ordering platforms and the ability to embed, as Rob mentioned before, there are so many different puzzle pieces in the world of payments as a whole. When you add into that mix the whole supply chain, a logistical kind of jigsaw puzzle, and you have to piece all of these things together, it may be challenging, but I think it's extremely rewarding in every sense of that word if you get that right.
Right. It's a huge opportunity and a new frontier potentially. I think that we'll be seeing a lot more of in the next couple of years. Okay. Next question. How have you seen any unlocks in terms of opportunities to pull in new buyers of new types of products that might not have ever been considered before embedded lending became a reality?
Yeah, I'll go with the first part of that. So I think again, it comes back to terminology. So it depends what you mean by embedded lending. But if we're taking the sense that we're on this webinar, initially, of course, certainly when it came into the public consciousness, I think it tended to be more consumerism, so fashion and so on. And certainly that's where a lot of the media coverage focused on.
Right.
But in reality, I mean, one could deploy it almost anywhere. I think some of the areas that are where we'll start to see, or are beginning, certainly some of the banks that FIS serves are seeing growth is in areas where once upon a time someone may have taken an unsecured loan or a credit card specifically for one transaction. And I'm thinking about things like holidays, so the travel industry. Less so, we're not talking here about buying a sofa or a TV, but lifestyle type opportunities. We even had a conversation about the concept of buying a car. So I think it's taking something that was perhaps somewhat embryonic, has matured, is getting over the hump of negative media coverage, getting some regulation, becoming mainstream, therefore being adopted by all sorts. So we're beginning to see some of that shift away from the traditional, I just want to buy a new pair of jeans online. It's certainly becoming far more part of everyday life.
Okay.
I think the other thing, Peter, like if you think about it, right, typical installment financing allows a merchant to advertise not only total cost of something, but what the affordable payment would be, right? And so as you're marketing that, you're now able to reach consumers' mindset from a, oh my word, you know, this was a $2,000 bike to this is a $40 a month payment. And so now you have consumers that may not have considered a $2,000 bike now looking at, oh, a $40 a month payment now becomes affordable to me. So I'm no longer thinking big dollars, I'm thinking smaller dollars for a big product. And that is allowing merchants to get more introductions to more people because they're able to see the affordability.
Right. So
it kind of comes back to this, but it kind of comes back to the authenticity point, right? Which is the general perception is less now about a Wild West for younger people to buy fashion, and now more mainstream. I can trust it.
Right. And so that sort of, it follows in with the next question. You know, what specific merchant types benefit from embedded lending?
Yeah. So I think in our world, again, we look at those merchants who, number one, are driving bigger ticket items. We are looking at goods and services that are not consumables. Ongoing types of expenditure is not what we look at. Maybe there are other type of cash flow solutions for it, but that's not the majority of the business, and that's not what we look at innovating for. I will say that one of the areas that we see developing nicely is the area of services, and obviously alongside goods, but there are certain services that, while they may be critical to one's well-being, mental well-being, physical well-being, that haven't necessarily been taken as seriously by some of the providers in the past. And I think we're starting to see how, with the right type of, again, tailoring, we are able to provide those type of solutions. One can think about co-payments, about various types of deductibles. It is not always an easy product because, again, services tend to be a little bit more complicated from an underwriting perspective than goods. But there are definitely areas where these type of solutions are needed. And there's some innovation that has to play a part in making it seamless, making it real time and responsible at the same time. But those are definitely merchant categories that we are, some of them we are already working with, and others we are exploring very, very seriously to find the right fit in terms of journeys and products.
Okay, so we got a couple of questions here on regulations. So we'll hit the first one. Do you see either the level and/or complexity of consumer regulations increasing? And if so, how will this impact finance providers in the space?
Oh, I can take that one. Rob, I'm sure you're seeing it as well, right? We are definitely seeing more activity from the regulators. There's lots of talk of figuring out how to regulate buy now, pay later, quite frankly, because fintechs are not prudentially regulated by any governing body other than, like being a good business, right? And they're acting in a financial capacity. And so bringing more regulation to that will most likely see consolidation within buy now, pay later, because they are not used to operating in a strict regulatory environment. That will increase their costs. That will increase the amount of work that they are going to need to do in order to be able to lend. And quite frankly, it'll also most likely change the type of models that they identify they use for like credit models for consumers. And so that is a huge shift for the buy now, pay later industry. I think also we are going to see additional, regulatory pressures, even in the traditional sense. Going back to the fact that you have an entire generation who's never been outside of a 0% interest environment. Now we're, in high rate environments. And that then goes back to some unfortunate players that, are predatory lenders, right? You have some places that I have seen where, they are charging interest rates in the mid to high 30s. Like that is untenable for consumers. And typically those interest rates in the high 30s go to low to moderate income people, right? Which then just it exacerbates, their financial problems. And so I think you're going to see more usury rules will be coming into play. I think you're going to see more, truth in lending will probably get tighter. I think, I would not be surprised if we wind up with a usury cap within the US at some point.
Mm-hmm. And what about Europe, Rob? Because there's another question here about upcoming regulations in Europe, and how will this change the products?
Yeah. You mentioned the word regulation, and people automatically think, oh, that's a bad thing. It's going to cost money. They have to take on more people, more reports. But actually, in this particular case, I think it's a good thing. The responsibility issue is a big issue. And actually, if you really want to take embedded lending really mainstream, to be almost ignored because it's so ubiquitous, then we need some form of authenticity to it that allows people to just be comfortable and do it without worrying. And therefore the predatory lenders, as Christine says there, that kind of behavior, and actually interest rates in the mid-30s is not as bad as some of the some of the things we've seen are up in triple digits. So we're back to, the old, as I think was mentioned earlier, payday lending kind of behaviors. And a lot of the firms that operate like that tend to believe, of course, that they may not be able to see that repayment through to its endpoint. So you get as much as you can up front. And I think that stuff needs to stop. We need to, these are financial instruments. They are the same as any other unsecured lending deal. They should be regulated, protected, so consumers have that degree of comfort. So that's why I think it's a more regulation in this particular case, is as long as it's not onerous, is a good thing. And it will allow those that are honest, reputable players to flourish. Particularly in Europe, I think that question is referring to some of the pressure on buy now, pay later, which has been around for a while. That will just fall into line with the rest of embedded lending. As I said, I think it will be welcomed by most that are reputable. The question for me is the extent to which we can recover from any negative press. I mean, typically, if you were to trawl media, printed media particularly, a large proportion, the vast majority, will be negative in terms of it's a debt problem, it's a consumer problem. So I think we need to get past all of that and make this a genuine, honest business before. And I think if we have to go a bit too far with regulation and then curb it back, I think we need to do that to get us to a point where it's accepted.
Okay. Another question is an interesting one. Do merchants hesitate on embedded lending as the debt burden may negatively be connected to the merchant's business?
I think this all ties back to choosing the right partner. This is precisely the reason that merchants have to be so careful in terms of who they let in, who they partner with. They have to make sure that the lender or the financial institution is performing the proper underwriting and that it is baked into the financial institution's model, meaning as opposed, and Rob, rightfully so, I mean, has mentioned the bad actors, or I'm willing to call them bad actors, who know for certain that an individual will not be able to make the payments all the way through the term, and they price it accordingly. I mean, aside from, I think, the moral issues and almost, I would say, the educational issues, it essentially is training a generation to take on debt they can't afford. And I think that in a very short time impacts the entire economy. But that is precisely the reason the merchants have to be extremely careful with who they choose to bring in to their checkout, to their brick and mortar stores. And that will ultimately dictate the success of those partnerships.
Yeah, Yakov. I mean, there's always a healthy tension, right, between us and our merchants when we look at approval rates, right? And merchants want 100% approval, and we explain to them that that's not how this goes, right? And we may not, quite frankly, we won't approve as many people as some of the buy now, pay later fintechs do, right? Because our models are very focused on, ability to pay versus, just whether or not they have, cash flow at the moment, right? We have, look, Citizens has over a 200-year history of being a lender. We kind of do this a lot. And so that history allows us to have models that really, I think, effectively identify those who are going to pay and pay over the life versus when you have fintechs that are, and a lot of them are fantastic. Please don't get me wrong, right? But they don't have that kind of history. And so they will approve more people. And quite frankly, you will see a lot more charge-offs as a result. And that is what then becomes negative on the business versus where you have a business that's looking at it more pragmatically from the right people taking installment financing.
It maybe just I think what Christine is also saying is the merchants need to understand that approving everyone is ultimately going to impact them in a negative way. Because like you said, the association with bad debt is association with the brand. So essentially having a very responsible lender performing the underwriting, making the decisioning in a way where We offer it if you can afford it. We don't if you can. It can't is a long-term strategy that benefits both the merchant and the lender, of course, and the consumer ultimately.
And you don't get any negative stories in the press that aligns your brand with a consumer that's struggling. Okay. Interesting one here about I think the crux of this question is about reporting to credit bureaus, because are there any modifications the banks have been making to their credit decisioning models to account for the fact that millions of consumers are borrowing at record levels and these are not being reported to the credit bureaus?
Well, Christine's
it's hard to adjust a model for something that you don't see. It's easier for us to understand that if you're a bank consumer, but quite frankly, it is a practice that needs to get regulated so that we can get that information into credit reports and then figure out how to use that, right? You don't want to make a instantaneous decision. If somebody has, call it 2 buy now, pay laters, right? Or they use them 3 times a year. That's really just spreading out cash, some cash components of a medium-sized purchase, right? And that shouldn't affect our calculations on whether or not you should buy a house, buy a car, things of that nature. Now, if you're somebody who's using 40 of them and continuously laddering, right, and therefore reducing your free cash flow on a constant basis, then we do need to take that into consideration. But until we have access to that data, it's a lot harder for us to predict whether or not you are a habitual buy now, pay later user or an occasional. So it's something that's we have talked a lot about, and is we're not quite in a position to have an answer to yet.
We've seen amongst banks, actually, we've seen efforts to try and, as Christine says, you can't legislate for things you don't know, but banks to try to understand or get some insight. So things like, and a bank is particularly well placed to do this, of course, because if the bank has checking account, current account, other relationships with the consumer, then they'll have access to more data. So it's the ability to gain access to a customer view within a data set. So that wouldn't be something that a standalone fintech embedded finance lender would be able to access. And then secondly is the use of, we're seeing some of this AI that was traditionally used in fraud prevention being deployed to look at the way that consumers behave. So a consumer alternating their behavior could mean in a particular way. So for example, curbing back on what was previously regular spending can indicate, and therefore if you have a relationship with that consumer, you can reach out and have a conversation. So there are ways you can try to see through it, but you never, you don't know empirically yet.
Okay, well, I think we are out of time. We'll have to leave it there. I want to say, firstly, thank you to Jiffity for sponsoring this webinar. And it really was a fascinating discussion here. Thank you for your insights, Christine, Rob, and Yakov. And of course, thank you to you, the viewer, for tuning in. Really appreciate it. Have a great day, everybody. Thanks again.
Thank you, folks.
Thank you.